Citi's global chief economist Nathan Sheets is with us. Nathan, great to see you again. Has your view been incrementally altered, at least by the data this week?
Well, I can tell you that we continue to expect a recession, most likely during the first half of next year, but we're not seeing any evidence yet of it in these data. I think on the one hand, you have a gradually moderating, and I would even say slowing, but a gradually moderating economy. And on the other hand, we're seeing gradual evidence of ongoing disinflation. And frankly, when I look at these data, what would a soft landing look like? And I think they'd look very much like what we're seeing. And the main reason that we continue to expect that recession is really based on history, that when the economy's been this hot and the unemployment rate has been this low, that the unwinding of that at some point in the process entails a recession. But, that's a pretty lonely call when I look at some of these kind of Goldilocks, for lack of a better term, these Goldilocks data.
So which would be a bigger mistake, Nathan, for the Fed to stop hiking now with core PCE still more than double the target, or for them to keep hiking as we've seen the continued step down in the monthly rate of inflation increases?
I think at this stage that the Fed has hiked significantly. Monetary policy by most metrics is restrictive. And I think what the Fed needs to do is maintain the type policy that it has and let the data come to them. And if over time they see that inflation is proving to be more stubborn than they expect, then they can hike a bit more. On the other hand, it may be that medicine that they've administered proves sufficient. And maybe they won't need to hike, maybe another 25, but not much more from where they are. But I think they can be empirical. I think they can be incremental. And I think they can be gradual at this stage. And frankly, for me, that was the major takeaway from Jay Powell's Jackson Hole speech last week.
Nathan, big number tomorrow. And what's your view for non-farm payrolls? And are you of the belief that you can start to see real disinflation, deflation without unemployment rocketing higher?
Well, on the second part of your question, historically that hasn't been the case. And our forecast certainly doesn't include that. But we have seen core PCE come down over the last 18 months. We've seen some moderation in wage growth, even as the unemployment rate has remained very low. And I think this is happening against the backdrop of a gradually moderating, again, I come to that word, gradually moderating labor market, where job gains, they're still solid. I think consensus is around 170 for tomorrow's number. Seems reasonable. We're expecting something a little lower because of the screenwriters strike, which could take a little bit off it. But a gradually moderating labor market, and if that moderation continues, then maybe we will be able to get out of this without a recession. But another aspect of this is the savings rate that we saw this morning was low. It was at 3.5%. And what does the adjustment of that savings rate look like, and what does it mean for the labor market?